futures trade into the market, can we take an implicit spot price from there, and can we try to figure out, can we make returns from referring to that price? So that's all I wanted to take. I'll talk in detail why we are doing what you're doing, but here is a small introduction. In fact, in an ideal world, I would like to roam around and then talk, is that fine? So in an ideal world of complete market, as we know that with no transaction cost to perfect information, it says that the cost of carry model of futures prices can predict the prices precisely. Now, but unfortunately, we don't live in that ideal world, right? So then we very much see that the futures prices often deviate from this cost of carry model. Now, because these prices deviate, there are several reasons that has been identified for this deviation, and some of them are, for example, non-synchronous trading. Non-synchronous trading, because trading is not happening at the same time in the two markets, so one market is perhaps reflecting the recent information, that is why the prices deviate. Inefficient pricing models. Now, this is one of the important concerns, but there are certain papers which have compared the various pricing models, including cost of carry model by Ramaswamy and Sundaresh, and there are several papers that have come up, and they've compared the models, and they have still found that this cost of carry model is still applicable and gives the very precise and close estimate. So maybe I'm not going to look at, but there is a third reason which I'm interested in to look at, which is informed trading into the futures market. In fact, if we look in detail, so what we do out here, we investigate the time series behavior, because what we are looking at, we are computing using the cost of carry model, computing the implicit spot price into the futures prices, and then we are comparing the implicit price with the observed market price. So there is going to be a deviation, and because we are expecting that this deviation is going to be a measure of return, we are trying to look at, is there a pattern into this deviation itself? So that's the first thing we are examining. The second thing we are examining, the information content into the deviation. We also test for consistency of our results, that when we consider the liquidity of the stock, when we consider the size of the stock, our results are going to change or not. And then we are talking about trying to find out if there is a portfolio strategy that can be built on based on this price deviation, and returns can be enhanced. So that's what we are looking at. Now, why we do what we do? This is the important thing which drives our entire study. There are several papers that say that, and in fact, Black in 1975, he said that informed traders should be attracted towards the derivatives market for the simple reason that there are trading mechanisms that provide them the benefits, such as lesser transaction costs, such as less upfront money requirements, such as no trading restrictions. So these are the things which may invite a trader with information to trade into the market and benefit the max. Now, a series of empirical studies have examined those phenomena, and they have confirmed this proposition that yes, there is informed trading happening into the derivatives market. But the point is, most of the studies that I have found into the literature, they are on the options market. And if we look at options market, in fact, they are the most popular market worldwide, which unfortunately is not seen in India. If we look at Indian derivatives market trading pattern, perhaps I'll show you there. This is how it looks like. I mean, when we talk about contract, this is based on contracts trading in the Indian market, contracts traded worldwide. We see that if you look at options, if you look at stock futures, perhaps since beginning, that has been the leading contract in the Indian market, at least till 2009. Thereafter, you see a drop, but still it is ranked second. Whereas if you see worldwide market, you'll see that perhaps the options are the highest traded contracts, whereas the stock futures, single stock futures, is the least traded contract worldwide. This is where India is different. And this is perhaps one thing that has encouraged me to look at this link. One, popularity of the contract, and then the informed trading happening into that particular country. So this is why I've chosen this one. Now, that is why the empirical examination of informed trading as one of the possible reasons of disrupted cost of carry relationship is imperative and due in Indian market. Now, this is just to put a glance about the literature that I have gone through about derivatives market informativeness. And you see several classes of papers where everything is there. I mean, there are people suggesting that derivatives market lead because the informed trading happening at that pace. There are papers suggesting no, it does not, and they have given their own argument why it does not happen out there. And there are several approaches, there are several variables, price variables, volume variables, trading activity variables, other trading activity variables that have been used. So this is just to provide a remark, a way out or an overlook that perhaps there is no clear-cut answer yet whether it really happens into the market or not. So I'll go ahead and I'll talk about perhaps my study. This is one of the papers that I'm presenting here. Just I'll give you a glance because this is one of the papers that I've referred. This was the paper published in Journal of Finance long back in 1982. But what they did is they inferred that perhaps the informed traders are trading into the call options market. So what they did is they used Black-Scholes option pricing model. They computed the implied spot price. They looked at the deviation from implied stock price, and they said, if at all informed trading is happening into the options market, then this implied price should guide my observed stock price into the market. Now, if that is happening, then there is a very high chance of making profits. So that is what they have done, and they have used a portfolio strategy based on that price deviation. They ranked the stock from the portfolio and tried to look at the portfolio returns pattern. And they have also tried several tests to justify their return, and in fact their conclusion says that closing prices of listed call options contain information about equilibrium stock price. Now based on this, I have tried to replicate this idea on single stock futures contract in India, because single stock futures, the most prominent traded contracts into India as far as the derivatives are concerned, and then because they are derivative contract, they share the same feature of being derivatives. There are lesser transaction cost, there is short selling possible, so all those things perhaps may invite informed traders into the spot futures market. So here are 4 objectives that I have identified. One is I'm examining the time series behavior of that deviation. Another is to examine the mispricing in SSF and about its informativeness. Third is I'm trying to look at whether for a very liquid form or large size form, whether the pattern is different from for a smaller form and liquid forms. And there are reasons why I'm going for that. And then I'm also trying to look at whether this pricing error, which I call pricing error or this deviation, is providing any incremental information over and above the important factors that were identified in literature and the 4 factors, market, SMB, HML, and WML by Carhart. So I'm examining whether there is any extra over and above return over those factors provided by those pricing areas. Now these are the methodology that I'm using. This is just to examine, this is like setting up the table where I'm talking about day of the week effect into the pricing error series and month of the year effect, where this is very, very popular models where I'm having 4 dummies and my reference day is Friday in the first model and my reference month is December month in the second model, and this average delta bar T is my cross-sectional average of pricing error on a day T. So that's the model. Then I go, this is how I calculated my portfolio returns. This is like weighted portfolio returns for the reason that my study period is running from 2004 to 2011. Now we know that in 2004 the number of stocks trading in the derivative segment was quite less compared to what it is now. So across the time, the number of stocks trading into the portfolio segment itself have increased. So what I've done, if I'm computing portfolio returns in 2004 and portfolio returns in 2011, there would be heteroscedasticity because of the number of stocks changing. So what I'm doing is I'm taking the number of stocks as a weight for different portfolio while I'm averaging the portfolio returns across time period. So that's the entire idea, and this way I'm computing the average portfolio returns. Thereafter I'm testing for non-synchronous trading as well. And there I'm expecting that my the coefficient Ci in this case should be negative. And there is a reason. Let's say on a day there is a positive news about a stock. Now on that day, the stock should move in the positive direction, my future should move into the positive direction. Let's say there is non-synchronous trading, which means, let's say the last trade happens into the futures market. In that case, what would happen, or let's say the last trade happens into the stock market. In that case, what would happen, my futures, if I take the closing futures price, and try to compute the implicit spot price, that will give me a little older price compared to what my closing is. So what would happen, the way I am computing my pricing error, which is implied minus a spot, that will go negative, whereas my returns on that day, because the market has moved up, would be positive. So my CJ coefficient has to be negative in that case. So if it is negative, then I would say this is due to non-synchronous trading. So that's one thing. Thereafter, I'm going to look at, here I would expect my alpha P to be significant in case this pricing error is providing any incremental information above and over those 4 Carhart factors. And thereafter, I'm going to do a long-short portfolio strategy where I'll be selling the lesser rank portfolio and buying the higher rank portfolio strategy. Here, I won't expect my alpha P to be just significant, but positive too, to have a significant positive return. So that's the entire expectation from the model that I'm using. And now I'll go to the empirical results that I have got. Now this is pretty much clear. I mean, you can see that Friday was my reference day. That is significant. Of course, my pricing error is not 0. It's different from 0. And I find that on Mondays, the pricing error is significantly different compared to other days. Other days, we don't find significant relationship. We can say perhaps because there is 2 days gap and then there is lot of accumulation of information and those traders can only trade on Mondays, so maybe that is why there is a significant pattern on Mondays. Thereafter, I'm just reporting for the months which I have found significant. There are other months, the dummies for that, but you can see that December is different from 0 and there are certain months, January, February, first quarter months, right? Then they are very much close to announce their quarterly results. June, August, October seems like the time where the company is almost about to disclose information, the quarterly information, things like that. That is the time where we are finding the months significant. Though this is just prelude, based on this, what we tried to find out, if you look at my previous results, my Monday was significant. What I've tried to look at is this Monday in those months again causing this effect. So there are months found significant. Is it prominent Monday effect even in those months? So to confirm this, I went again and have run a dummy variable regression where this is how I have classified the category. My D1 would take value if my observation belonged to group 1 and Monday, where my group 1 is all the months having significant things and group 2 is months which are not having significant things. And in this way, when I classify my dummy variables, if I get my D1 to be significant, I'll say that even in those months which are found significant, it is prominent Monday effect. So if you look at my D1 variable, of course, that seems to be again significant, which is saying that there is a very high chances of having a very large pricing error, significant pricing error on Mondays. I have not yet confirmed whether this is due to information or not. I'm just saying this is so far the pricing error pattern. Now I'm going to look at that. What I've done is, based on that pricing error, I have ranked the stock on every day. And I have formed portfolio, I have formed quintiles. So based on the ranking of that pricing error, I have formed quintiles. And then I have taken average portfolio returns on daily basis. And then across time period, I have taken the average returns of those portfolios. So this is my portfolio 1 consistently across time period, 2, 3, 4, 5. If you look at, I have 2 expectations which are meeting here. One is from low to higher rank as I move, my portfolio returns should be increasing fast, right? Because the rank 1 is lowest rank portfolio and rank 5 is my highest rank portfolio. So I'm expecting a lowest return for rank 1 and highest return for rank 5. And then this should be significant, of course, which is implied. So, and if you look at, perhaps I'm getting that pattern where from lower rank to higher rank, my returns are increasing and I'm getting them significantly different from 0. Now I have applied 2 tests. One is ex post and ex ante. In ex ante, what I'm doing is, the way I'm calculating my implied is, I'm taking the closing price, right? I'm applying my cost of carry model, computing the implied price of the stock and comparing it with the observed price. The point is, and then I'm expecting that if there is a pricing error, I'll take position into the mark on the closing price. Now that is practically not possible, right? Once the markets have closed, now I have identified opportunity, I cannot buy at that price, right? So what I've done is, I have reduced to 1 day. Today I'll decide the pricing error. Next day I'll buy the stock and sell it at T plus 2 days. So what will happen in the entire process, I'll get 1 day less. So my total number of studies, total days of study will get less by 1 in this case. However, I don't see any significant returns. Though I find the trend yet. I have not gone to nail down the 4th decimal point out here, but it seems that the trend is still maintained, but we don't see significant returns. I'll explain why perhaps we don't see the significant returns, but before that I'd like to explain the other tests that we have used. And this test what we have used is, I have tried to put a matrix of portfolio 1 to 5 ranked based on their portfolio ranking and ranked based on their returns. Now if you look at my logic, what we are trying to look at, the minimum rank portfolio should be giving me minimum return on all the days as far as the ideal theory is concerned. But the point is, you won't find that situation into the practical market. So I have total 1490 days of study from 2004 to 2011. Out of that, I found that my portfolio 1 is giving minimum return for 1456 days. It has appeared at number 2 for 21 days. It has appeared at number 3 for 4 days. This is how I have created the matrix. And I want to test whether this matrix is significantly different from a random matrix or not. Now in a random matrix, my observation everywhere would be 1490 upon 5, because I have total 5 sets, right? So I have tested, and in both the cases, that is for x ante and then x post and x ante. In both the cases, you see my chi-square statistics is quite significant, which is suggesting that this distribution is quite significantly different from my random distribution. Now, if you look at my x ante return, the portfolio returns, you will remember they were not significant. Now, there is a reason. The reason explained here is, and that is in literature too, that maybe when we compare portfolio returns, let's say on one day, a minimum rank portfolio, they have got some stock which have given very high returns. What would happen? A minimum rank portfolio is appearing at rank 5. Due to that, what would happen? The difference with other portfolio will deduct, and the variance in that portfolio would shoot up. That will render your T statistics insignificant. Because that is a parametric test. This is a non-parametric test. That is why you are getting a significant result. So that is one of the reasons why we can get the results the way it is. But it is very much confirming that still there is evidence of informed trading into the futures market. Now I'll go ahead. Here, if you remember the non-synchronous thing I talked about, where I'm going to look at is this pricing error due to non-synchronous trading. And I said I'm going to look at whether my CJ is having a negative or not. And if you look at out of my 265 stocks in total that I have considered across the time period, for 262 stocks, the coefficients was positive. Out of that, 248 was significant. Just 3 were negative, out of just 1 was found significant in my ex-post test. So, I mean, it clearly says that this pricing error is not due to non-synchronous trading, but it is due to informed trading happening into the futures market. Now, this is because we have argument that informed traders prefer to trade where liquidity traders trade. They can hide themselves into liquidity traders. That is why the argument is that is why a very liquid stock should have a very high informed trading happening in that place. I have taken 2 measures of liquidity, amount liquidity and then the total turnover. And the another parameter that I have considered is firm size. So what we have done is, now if you look at amount liquidity, you know this amount measure is a measure of illiquidity rather than liquidity. So here rank 4 is the least liquid stock, whereas rank 1 is 0 is the highest liquid stock. And you see an increasing pattern from 4 to 0, which is confirming that yes, there is an evidence of informed trading. Whereas turnover simply is a measure, total number of shares traded divided by total outstanding stock. So that is a very simple. So 0 is the least liquid stock and 4 is the highest liquid stock. There you see the pattern again increasing. Though we don't find any significant relationship for size, even the pattern. We find a pattern on turnover parameter, but still they were not significant. However, if we look at returns based on amount parameter, which of course is a very refined parameter as far as the liquidity is concerned, in literature it is referred as. So there I find a significant, the only argument that I can find why my amount is significant but my turnover is not, because that is perhaps a refined parameter and pretty much prominent in literature. So we find that perhaps the high liquid stocks, their informed trading is much compared to the lesser liquid stocks. Now this is my normal 4-factor model that I have run, and if you look at, I expected my alpha to be significant in this case, which you find for every single portfolio that my alpha is significant. Though you can expect the same trend here, and which is evident out here. Even for other coefficient, for example, in other research literature, they observe that the market coefficient is close to 1. And even in our case, we find our market coefficient, excess market return is close to 1. And there are other parameters. Adjusted R square is not quite less. I mean, it's given a finance paper, it's quite substantial. And we find a very, very significant result based on this, where we also confirm that yes, this significant alpha indicates that this pricing error is providing incremental information, incremental returns over and above what other 4 factors are able to explain. And then I went on and sorry, do I have the portfolio? Yes. And then the last column, if you look at, that is long-short strategy column. There, I don't expect my alpha just to be significant, but positive too. On average, it seems that 0.05% of return on daily basis I can make if I go through this portfolio strategy exercise, which is quite good and quite important. So that's all about return. We have conducted this for ex-ante as well, but if you remember, our ex-ante portfolio returns were not significant, so I have not included the table here because they are not significant in that case too. But non-parametric test confirms, and this test very much confirms that there is informed trading happening into the derivatives market, particularly single stock futures market in India. Based on that, the conclusions that I have put here is the price discrepancy between the spot and futures market is the result of investors' risk premium demand, and that risk premium demand and the degree of price discrepancy between the two markets varies with time. Because if you remember the time series behavior, we have seen fluctuations. So it varies with time, and because they are investing in stocks, they demand certain risk premium for getting into risky stocks. That is why perhaps that is why this is coming to be a significant factor. Closing prices of single stock futures are informative about next day equilibrium stock price, and it provides significant profitable opportunities for traders if they do this exercise. The good thing about this particular paper is, of course, I'm using publicly available data. So, and the cost of carry model, if I get into options, I understand the model itself is complex. It's not very easy to understand. But cost of carry model, you apply your logic that there has to be something for time that you carry. If you enter into a contract for future period, you have to pay a little higher. You understand that phenomena of consumption. Perhaps you will be able to figure out a price, and there you can find the deviation and apply the same logic. So based on this, there are certain implications. If you remember, one of the characteristics is short selling restriction is not there into the futures market. If you look at the pattern of my pricing error series, you'll find prominently they were negative. And pricing error would become negative when mostly the negative informed traders or traders on negative news, informed traders on negative news are trading into the futures market. They'll render the price go down. That is why your implied the entire deviation would become negative. So that is one of the reasons. Perhaps I don't know if regulators would at all look at my paper, but if at all they look, our results signify that regulators should reconsider the imposed short selling restriction in an attempt to reduce the prevalent inefficiency in the Indian market. The evidence that SSS prices are indicative of actual stock price in future is helpful for portfolio managers, hedge funds, and institutional traders in maximizing their portfolio returns. That's what I conclude, and that's what I recommend based on my paper. That's all from my side. I would be happy to take questions. Yes, please.
That non-synchronous trading.
Should I go to that table?
No, not necessarily. A priori, I can expect this type of result. Because the stocks which are in the derivative segment, you don't really find that type of a problem, because if you have that huge non-synchronous trading, that stock would not enter into the derivative segment, because that's the criteria.
There's one criteria, right.
You have used your NSE.
Right.
And then the other one is you have used daily prices, right?
Yes.
So, because of the criteria that MSE uses to bring a stock into the derivative sector, and then the daily prices that you have used, non-synchronous trading may not be a problem. That's why this type of result.
Okay. The one thing that I could think of is perhaps even in derivative segment, I understand that there are liquid stocks which are trading into derivative segment, but there is degree of liquidity even in those sample of stocks, right? That may differ. So that may perhaps be one of the reasons why still this analysis can apply.
If you use maybe high density data, you are non-synchronous.
Right, I understand. Intraday data would certainly give a better picture, but my intention was not to get into intraday data just for my research purpose. It was also to use publicly available data. Would it be helpful to a normal public in some sense? Perhaps that is one of the motives that I carried, and that is why I used publicly available. But I absolutely agree. Perhaps if I use intraday data, that may give more insightful results, perhaps. Yes.
And the other two observations is, you have taken date as Monday to Thursday.
Yes.
My question was also with
why did you omit Friday?
No, Friday, my intercept is capturing that, right?
For Friday also you have.
Friday in December he has taken.
No, I'm just, okay. I'll come to both questions because both questions are different. So just give me a moment. If I can go to
And then related to that, you said Monday effect has a spillover effect on the month effect.
Yes, I'm going to explain that.
Oh, how did you?
Yes, just give me a moment.
Yeah.
So this is my model, right? Where my dummies are, D1 is Monday to Thursday, right? And my intercept is capturing the Friday effect, right?
Intercept captures the Friday effect.
Yes, that is how the dummy variable model is, right? You have to have one lesser dummy than the number of parameters that you are estimating. So my alpha would capture the Friday effect here. Now when I go to results, if you look at my results, here, so my intercept alpha is significant, which I am saying my Friday pricing error is significantly different from 0, but for other days my Friday becomes the reference point. So my Monday is significantly different from Friday, but not other days are significant. That's the dummy variable regression model. So
And how do you interpret that Monday effect?
from this second, in this second,
on January effect.
right, so I'll tell you. In this second, what I've done is I've just presented the months which are significant. So other months are not significant. So I have grouped them. Group 1, significant months. Group 2, non-significant months. And then I did this regression analysis. So what happened? I'll take my D1 will take a value 1 if it belongs to group 1 and Monday. Similarly, group 2 and Monday, group 1 and other days, group 2 and other days. So 4 dummies, and then I run the regression. Then my results will tell you if still I have dummy 1 significant, which indicates that even in those months is prominent Monday effect. That's how the dummy variable is playing it.
And the last observation from
Yeah, please go ahead.
your cost of carry model you have applied to the near month or mid month or
No, just near month. Yes, absolutely. I forgot to mention, but I've just taken the most liquid contracts which are near month contracts. It's not the far month. Please.
Here was observation. Go back to that third statement you are telling us. Go back.
Just this one?
Yeah. I don't know whether I'm right or wrong. I just want to say something. The R square is more than 1.1.
It's not. I have written percentages. So look at them carefully. It's very less. It's the less than 1% R square getting explained. 0.58% R square. It's not 58.
Then it is 0.001.
Right, I understand. That's another way of representing it. But I wanted to look my statistics little glamorous, right? So I have put that way, 1.19%. But you're absolutely right. This is not more than 100% explanation. No. This is very meager explanation, but in finance literature, if you look at the papers, your R squares, I was fortunate to get a very high score in my Carhart factors model, but it's close to 1%, close to 2% in most of the cases. And that's how it is.
Yeah, good presentation.
Thank you.
Nice presentation, but my question is why you have taken Friday and December as your benchmark? Why only these two?
Right, I understand, ma'am. I got your question at that point in time. Is I was free to take any day, right? Monday, Tuesday,
Yeah,
Wednesday,
you can take.
right? There was no specific reason, to be honest. But if somebody asks me for a reason, I'll say because I see on Monday, I can take either Monday or Friday for a reason because there is a 2-day closer interval.
Either on the basis of literature review, you should be justified why you have taken
Right.
this. On the basis of literature review or on some other basis.
Right, so
There
that's
should be
where I'm-
some,
that's
there
where
should
I'm
be some justification for
Okay,
it.
that's where I'm coming. So in literature, either they take Friday or Monday for the reason because there is almost across market there is 2 days gap. So they can capture that effect. So that is one of the reasons why I've taken that.
Most of the, if I'm not wrong, most of the institutional investors, they will book the profit during December.
Yeah, but I just wanted to mention all the logics why he has taken those.
Right. So that is very much coming from the literature, ma'am, to be honest. Yes, sir. And
Nice presentation.
Since I congratulate you, this is a very nice study. But table 7 and table 6, the 4-factor model that is proposed by you,
Carhart.
Carhart, right?
4-factor